There is a thing the brain does with money that almost nobody talks about. Anything exciting feels important. Anything boring feels optional, even when the boring thing is the one quietly building your future. The people who actually end up wealthy are not the ones doing dramatic things. They are doing tiny, dull, almost embarrassing things for decades. And the reason you are not doing those things yet has very little to do with intelligence. It has to do with how your brain decides what counts as worth your attention. I am Max. This channel is about wealth psychology, what your brain actually does with money, and why. Today we are going to look at 4 habits that quietly build wealth and the 4 reasons your brain refuses to take them seriously. These are not new tricks. They are things you already know exist, and that is exactly why they are easy to dismiss. Subscribe if you want the version of personal finance that actually works once you understand the brain operating it. Walk into any bookstore. The finance section is loud. Big promises, big returns, big stories of people who timed the market and won. Almost none of those books describe what happens in the accounts of people who end up financially comfortable. The data is quieter than the marketing. The researchers who track this stuff keep finding the same pattern. The most reliable wealth behaviors are not dramatic. They are quiet, repetitive, and slow, which raises an obvious question. If we already know this, why does almost nobody do it? The honest answer is that the brain was not built to notice slow things. It was built to notice contrast. Behavioral economists call this salience. When 2 options sit side by side, the one that stands out gets disproportionate weight in your decision. Even when it is the worst option on paper, the salient thing wins. The vivid thing wins. The boring thing, even when it is the correct thing, gets quietly skipped. That is not a personality flaw. That is the default operating system, which means the habits that build wealth work against how your attention naturally moves. So let's go look at the 4 habits your brain quietly refuses to take seriously, and why each one works exactly because of that refusal. Picture a guy who opens his brokerage app and finds 2 things waiting for him. The first thing is an index fund that has quietly gone up for years. It looks like a very gentle hill on a graph. He calls it boring and closes the tab. The second thing is a meme stock that jumped 60% in 3 days. It looks exciting. He buys. That tiny decision, made in maybe 7 seconds, is the first habit working against him. Call it the boredom discount. Whenever a reward sits at the end of a dull, repetitive path, the brain automatically lowers its perceived value. Not because the boring path delivers less, because the brain weighs the path itself as if it were part of the prize. Behavioral economists like Boredom, and Schleifer describe it as the brain assigning extra weight to attributes that stand out. The exciting option looks bigger than it is. The boring option looks smaller than it is. That distortion happens before you start to think. Other researchers, Greenblatt and Kelleharju, studied investors prone to sensation-seeking. They trade more. They trade more often. They trade more aggressively. In the classic Barber and Odin study, households that traded most earned 11.4% a year, while the market returned 17.9%, 6.5 points a year. Paid for the privilege of feeling busy. The boring option was not losing while he chased excitement. It was quietly winning. He just was not looking at it. This is why your friend who never talks about investing is somehow doing better than the one who talks about it constantly. The loud one is paying for entertainment with his returns. The quiet one is letting the boring path do its job. The boredom discount is not your enemy if you can see it operating. Once you notice the brain shrinking the calm option, you can stop trusting that shrinkage. The boring option was not losing. You just stopped looking at it. 2 co-workers. Same company. Same salary. Same job title. The first one transfers money to his savings account manually every month after he pays his bills and sees what is left. Sometimes he does it. Sometimes he forgets. Sometimes there is nothing left. The second one set up an auto transfer 3 years ago and has not thought about it since. The same $400 leaves his checking account on the 1st of every month, before he sees it. At year 3, the gap between their accounts is no longer subtle. Neither made smarter decisions. One just removed the decision entirely. This is the automaticity advantage. And it is the cleanest example of how boring beats motivated. Psychologists Peter Gallwitzer and Pascal Sheeran ran the meta-analysis on this. Across 94 studies, simply linking a cue to a response, what they call an implementation intention, produced a medium to large effect. A measurable effect on whether people actually followed through on their goals. Removing the decision is not a weak move. In the data, it is the move. Every time you ask your brain to actively choose to save, you are also asking it to choose against something else. A dinner, a trip, a shoe. The brain loses that fight more often than people admit. Automation works because it removes the repeated decision. Every repeated decision is another chance for friction or temptation to win. The retirement system gives us the cleanest real-world test of this. When a company makes 401k participation voluntary, meaning employees have to opt in themselves, participation in 2024 was around 64%. When the same company makes participation automatic, employees are enrolled by default and have to actively opt out, participation jumps to 94%. And the contribution rates follow the same shape. In Vanguard's How America Saves report for 2024, automatic enrollment plans saved an average of 12.1% including employer match. Voluntary plans saved an average of 7.6. 30 extra points of participation. Almost 5 extra points of savings rate from not asking the brain to decide. Richard Thaler and Shlomo Benartzi tested a more extreme version. They asked workers to commit in advance to letting future raises automatically increase their savings rate. No repeated willpower required, just one advance commitment. Over 40 months, average savings rates among participants in their program rose from 3.5% to 13.6%. Most of them stayed enrolled through 4 pay raises. This is what automation does. It changes the default from decide every month to stop me if you want to opt out. The first version requires you to win a small fight every month, for years. The second version requires you to win one fight once, ever. Here is the part most people miss. The brain interprets effort as proof that something matters. So when something happens with no effort, your brain quietly classifies it as unimportant. Even when it is the thing actually building your future. The decisions that keep working over decades are the ones you made one time and never had to revisit. The decisions that fall apart are the ones that require you to keep choosing them, over and over, against a brain that gets tired. The decision you never have to make again is the one that actually keeps working. Almost everything important in life follows the same shape. The dramatic version gets the attention. The repetitive version gets the result. Money is the worst version of this because the dramatic story sounds so much smarter than the boring one. Compound interest, told accurately, sounds like a math trick that probably will not work for you. The numbers feel made up. The timeline feels insulting. But there is a reason the boring math feels unbelievable. Researchers Victor Stango and Jonathan Zinman gave it a name. They call it exponential growth bias. The human brain, when shown an exponential function, automatically flattens it into a straight line. Which means when you look at a long-term investment chart, your brain is quietly underestimating what the line will do in the last few years. Goda, Levy, Manchester and colleagues confirmed this bias is not just academic. In nationally representative data, people who scored high on exponential growth bias also saved less for retirement. They literally save less because they cannot feel the math in their bones. Let me make this concrete. Imagine 2 people putting $300 a month into a broad market investment. Same contribution, same return assumption, let us say 7% nominal a year, compounded monthly. Both stop contributing at 65. The person who started at 22 ends with about $983,000. The person who started 13 years later ends with about $366,000. Same monthly amount, same return assumption. Almost 3 times the result. The only variable was time. The only behavior was not stopping. And that is exactly why people do not believe it. The math is too quiet. There is no event. There is no moment. There is no big decision. There is just years. Years are boring. Years are also the entire engine. Morningstar runs a study every year that measures what investors actually earn versus what the funds they own actually return. In the decade ending in 2024, the average dollar invested earned 7% a year, while the funds themselves returned 8.2. 1.2 percentage points a year. Not from picking bad funds. From the timing of when people put money in and when they pulled it out. The more they touched their accounts, the less they earned. The pattern is so consistent that researchers can practically use it as a definition. The investors who do best are not the ones doing the most. They are the ones doing the least, the longest. Consistency is not glamorous. It is not interesting. It is not something you can tell at a party. It is the closest thing the world of money has to a guarantee. The math is not about amounts. It is about years. And years are boring. Imagine you have been contributing to a retirement account for 2 years. You finally log in to check it. The balance has grown. It has grown by an amount that, against the timeline of a 40-year career, is meaningful. Against the timeline of your weekend, it is invisible. 2 years for that. And the brain has a very specific reaction to invisible progress. Behavioral researchers Caitlin Woolley and Ayelet Fishbach studied what actually makes people stick with long-term goals. Their finding was clean. The presence of immediate rewards was a stronger predictor of adherence than delayed rewards. This is not a moral problem. The brain weights immediate rewards more heavily than delayed ones. And the longer the delay, the heavier the discount. The data shows up most clearly at the worst possible moment. A 2022 study by Wang, Zhai and Lynch tracked over 162,000 employees across 28 retirement plans. 41.4% cashed out their 401k at separation. Most drained the entire balance. 4 in 10 people, at the moment their retirement account most needed to be left alone, treated decades of progress as a one-time bonus check. Not because they were reckless, because the account never felt like theirs. The Employee Benefit Research Institute estimates that roughly 4.5 to 6.5 million 401k participants cash out every year. That is somewhere between 6.5% and 9.5% of all participants. The thing about retirement accounts is that they were designed to be invisible. They run on long timelines, low feedback, and almost no narrative reward. The brain reads this as not real. A reward you cannot see or touch for decades does not register as a present-tense thing worth defending. Researchers Dean Carlin, Margaret McConnell, Sendhil Mullainathan, and Jonathan Zinman tested this directly. They sent small reminders to people with commitment savings accounts. The reminders measurably increased the chances those people would actually meet their savings goals. The underlying goal did not change. The math did not change. What changed was that the goal briefly became visible again. Most people do not quit savings. They quit the feeling of saving. The account never disappeared. It just stopped feeling like yours because you could not see it moving. This is also why people will obsess over a daily budgeting app and ignore an account doing 10 times more for them. The app shows progress. The account does not, which means the fix is almost embarrassing in how simple it is. If invisible progress is the problem, make the progress visible. Set the reminder. Print the chart. Track the number monthly. Manufacture the feedback the system was not designed to give you. Now here is the part where someone watching this is mentally pushing back. And they have a real point. The argument goes something like, easy for you to say. Automatic transfers work for people with money left over. What if you do not? The objection is fair, and the answer matters. If someone is genuinely living on zero margin every month, no automation in the world can manufacture money that does not exist. That is an income problem, not a behavior problem. It requires a different conversation. No script fixes what no paycheck can carry. But the audience this video is built for is not zero margin. It is thin margin. A surplus exists most months. The surplus just gets reabsorbed before it becomes anything. And for thin margin households, the automation research is actually more important, not less. Casey Newmeyer and colleagues found that automated savings particularly helped lower-income households build liquid savings when they were paired with an actual savings orientation. The amount does not have to be impressive. $20, automated, beats $200 promised and forgotten. The point is not the size of the transfer. The point is the existence of the transfer. The brain is much better at protecting something that already moved than at deciding to move it. Start at whatever number does not require negotiation. The point is to build the rail, not to fill it. Because once the rail exists, raising the number is just a slider. Without the rail, no number ever lasts. Alright, here is how this actually translates into something you can do this week. For small moves, none of them dramatic, all of them boring on purpose. First, pick one financial decision you make manually: savings, retirement contribution, debt payment, and automate it today, even at an embarrassingly low number. Second, if your employer offers a 401k or equivalent and you are not in it, enroll. If you are in it, check your contribution rate. Raise it by 1%. You will not feel 1%. Third, build a feedback loop the system did not give you. A note on your phone calendar, a wall chart, a quarterly check-in. Anything that makes the invisible thing briefly visible. Fourth, cut the inputs that are designed to make boring habits feel boring. Trading apps, finance influencers who reward novelty, anything that pushes excitement into your financial attention. Mute, unfollow, delete. Do those 4 things and your financial life starts running on rails. The rails will not look impressive. They will not feel impressive. They will just work. If this kind of thinking interests you, there is one book worth your time on exactly this subject. Morgan Housel's The Psychology of Money is the cleanest popular treatment of why boring usually wins in personal finance. There is an Amazon affiliate link in the description if you want to grab a copy. No pressure. The video stands on its own. Here is the thing nobody tells you about money. The wealth that lasts almost never comes from a moment. It comes from 1,000 small moments your brain refused to take seriously, repeated until they became the whole story. The person who automates a small transfer at 22 is not making a dramatic decision. They are making a decision so small that no one, including them, will remember making it. But that is the trick. The decisions that end up shaping a life are almost never the ones that feel important when you make them. They are the ones that feel small enough to dismiss, and that you accidentally let run for 30 years. The brain hates this. It wants the dramatic version. It wants the moment. But the math does not care what your brain wants. The math just keeps counting. So the question is not whether the boring habits work. Automation, time, and consistency keep showing up in the data. The question is whether you can let something this quiet matter to you every month for the next 40 years. If you found this useful, subscribe. I will see you in the next one.